Good afternoon, everyone. Thanks for joining this call. I'm Abhinav Khanna from ValueQuest. It is ValueQuest's pleasure to host each of you for the launch of our new PMS, which is called POISE. POISE combines the science, art, and vision of investing. Over the next hour or so, the team of ValueQuest will take you through our philosophy behind this new PMS strategy. Initially, Ravi Dharamshi, who's our founder and CIO, he will make some opening remarks. And then Varun, our fund manager for POISE, he will take you through the whole story and philosophy behind POISE. Ravi, over to you.
Thanks, Abhinav. As the CIO and the founder of the firm, it's an honor and a privilege to stand before you today to introduce POISE, our innovative portfolio management approach. But before that, a short update on ValueQuest. Thanks to your support, ValueQuest has been growing tremendously over the last few years. Today, our assets under management have grown on to become 11,500 crores. We have a private equity strategy called ValueQuest Scale Fund, also operational now. It's been almost a year, where we have managed to raise almost 1,200 crores. And performance has continued to stay buoyant. Markets have been choppy in the last few days, but that's why we are here with something which provides poise to your portfolio. Our team size has also grown to become almost 65 people. And even though most of you probably know me and me as the face of the ValueQuest, but there's a large team behind me that is working day and night. And I think this is a testament to their hard work. Throughout our journey at ValueQuest, I have been privileged to be the face of the firm. But it's essential to acknowledge the collective effort behind our success. We are a team driven by excellence and committed to delivering our value to our clients. So POISE represents a pivotal moment in our approach. While it bears the hallmark of ValueQuest ethos, it stands apart in its unique approach. Unlike our other strategies, POISE is designed to minimize business and regulatory friction, ensuring smoother sailing in today's dynamic market environment. POISE isn't just about maximizing returns. It's about ensuring that our investors can rest easy at night, knowing that their investments are in capable hands. What sets POISE apart is its refined focus and meticulous selection process. By narrowing the investment universe, it enhances the ability to identify and seize the opportunities with a higher probability of success. In essence, POISE is not just about diversification, it's about precision and conviction in our investment decision. In a world where volatility and uncertainty after such a reign supreme, POISE seeks to navigate these challenges by investing in capital efficient business, by prioritizing companies with a track record of prudent capital management, and we mitigate unnecessary risks while maximizing returns for our investors. So we continue to stay true to our ethos of remaining sector agnostic and market cap agnostic, allowing us to identify opportunities wherever they may arise. Moreover, POISE strikes a delicate balance between concentration and diversification, ensuring a resilient portfolio that can weather various market conditions. Contrary to conventional wisdom, POISE challenges the notion that higher returns necessitate higher risk. Through meticulous analysis and smart selection, POISE aims to generate superior returns while minimizing exposure to undue risk factors. It's an all-weather approach, meticulously crafted to outperform markets through proactive elimination and strategic selection. It's worth noting that we rigorously tested this approach for 2 years before bringing it to the market. In fact, today we stand exactly 2 years from the day. 10th February 2022 was when this strategy was internally launched. We have been running this strategy with a small corpus. And today, of course, Varun will talk more about it and will showcase that the returns have more than positively surprised us. At ValueQuest, we remain steadfast in our commitment to innovation and excellence. With Poise, we reaffirm our dedication to navigating the complexities of the market landscape while delivering sustainable value to our clients. We understand that our investors place their trust in us to safeguard their future. With Poise, we not only embrace this responsibility, but also reaffirm our commitment to delivering consistent, sustainable returns without compromising the peace of mind. Thank you all for your continued support as we embark on this journey of prosperity and tranquility with Poise. With this, I will hand over the stage back to Abhinav, or maybe Varun can also straight away take it.
Sure. Thanks, Ravi. So Varun, the attendees would love to hear you expand on what Ravi mentioned just now. To all the attendees, you may put your questions on the chat, or once Varun is done, after 25 or 30 minutes, we will anyways, open up the session for Q&A. So you can ask questions then as well. Varun, over to you.
Am I visible? Yes. Thank you, Abhinav, for getting me in. Am I audible clearly?
Yes, Varun.
So, thank you, Ravi, for the kind words. I don't think so I would have articulated it as good as you have. Let me go through a short presentation on some part would be about our firm itself, and then specific to the product. Ravi's already given an introduction to where ValueQuest has reached, but just for the benefit of those who are attending, these are the key building blocks. Our firm AUM level, the firm has now PMS Crystal Bazaar rating the existing strategies, the team strength. The firm performance is now into the 13th year of top decile performance. And obviously the culture and work ethic is what defines us. Results are an outcome. The investment team, you already know, Ravi and Samir are the architects of the firm, but we also now have a very experienced leadership management team. Hiten, Chirag Bhai are old hands at ValueQuest. They are part of the founding team. Abhinav, Ankit, and Anand have recently come in the last 1 year. They are going to take the firm to new heights. This has always been our firm's core strength, that we are investors first. Our own capital is also on the line. And this whole approach of being investors rather than just asset managers makes a huge difference in our approach, in our attitude towards markets, managing expectations, relationships, and our whole learnability through multiple market cycles. So ultimately, our more than 20, 30 years of market experience has taught us how to eliminate noise. 1 day, 1 quarter, or 1 year is too short a time frame in the grand scheme of things. Our endeavor is to focus, while the effort is to deliver on 3 to 5 year rolling expectations, 3 to 5 years, but we need to have keen eye on what's coming in the entire spectrum of 1 to 5 years. I mean, more to drive the message that too short a term is noise. Our industry framework, as much as the word grit speaks for itself, the key building blocks is growth, return on capital, industry tailwind, thematic. While they're self-explanatory, I would just delve a minute into that. Industry tailwind is a very key building block in your alpha creation. So the ValueQuest team is always looking for industries which have the tailwind, which can drive growth to well above nominal GDP growth, and that growth can sustain over long term. Thematic, we always look for themes. It could be consumer, it could be financial services, it could be manufacturing, it could be other themes which are playing because of as the country progresses. I think our core remains in discovering and researching on those thematics. If one goes to the ValueQuest YouTube channel, you'll find a lot of work published around thematics. Building on the industry selection framework, which is common to the entire investment team, which is common to all the strategies, which is Platinum, Growth, and Poise, is that we are looking for a growing fish and a growing pond, which means to show that we are looking for large demand opportunity, which can remain as the country also grows. Also, there's one more depiction here that when the pond is small, the number of fishes probably could be higher. But as we move to the ocean, the share of kill lies with fewer players. So not only is it about the size of the pond or the size of the player, in this case, a company, but also it's about distribution of those profits has to be in fewer players. That's the essence of it. Excuse me. The key building block of company selection is called scale. Scale is the key abbreviation that the team lives by. Essence is scalable companies with sustainable competitive advantage, adaptable long runway, with superior execution capabilities. Ultimately, we're looking to distill change of scale and identify future leaders. And now that applies to both industries and companies. The second level qualitative insights, which is governance, structure, technology, capabilities, culture, and partners, allow you the latitude to see beyond the near term. Promoters, companies which are really building large scale organizations would be investing in these building blocks, and the same applies to our firm itself. The reason why now we have such a leadership team, the way the research team is now one of the largest in the industry, is because we are investing in these capabilities to identify future opportunities, which could be more complex. It could be more scale of ability to deploy larger capital. Now, this is the ethos that it all comes together, the wealth creation ethos that comes together in the firm, for which you require, obviously, team. So the x-axis and the y-axis. So the x-axis is duration and the y-axis is return. Now, most people are focused on getting only the return right, getting only highest return. But there are two other vectors which are very, very important to understand and give due importance to. One is duration, and the other is sizing of capital. So in asset allocation point of view, how much of your assets are in equity? But from a fund management point of view, how are you sizing the opportunities that are available to you? So on the left, return, which is degree of return, quality of return. Can we replicate this return over cycles and predictability of return? This is very important to understand from an investor who's investing large share of his net worth either with us or with equities. Duration, markets are complex and they're getting even more complex by the day. So can we deliver alpha? So ValueQuest last 13 years, alpha is for us to see, and we intend to replicate it, or the endeavor is over the next 10 to 20 years. Coming to my basic profile, without getting into too much detail, I have been 30 years amidst investing, around investors, or grown up hearing investing stories, and that's the only one idea that I stand by. But having said that, 22 years of capital market experience, 13 years on the institutional side, and 10 years on the non-institutional side. And this presentation would be available to everybody to see more details. Coming to Poise as the product, I'll cover a few basic philosophies and then I'll get into the product specifics. Like Abhinav had introduced, uh, there are three building blocks to understanding investing. One is science, which is the process part. There has to be a method to this madness. Contrary to popular belief, there is a lot of science, there is a lot of process to this industry. Second is art. If somebody has not understood the intangibles and softer aspects, will be missing a big part of the animal called market, or even ultimately the business is about people. So you have to understand people and a lot of other softer aspects. Even accounting today has a lot of intangibles not explained. So one has to understand that. And the third is vision, which is as analysts or fund managers and as a team, we need to have the vision. And sometimes that vision has to look beyond the shoulders of even the entrepreneurs who are running the businesses. I think this slide, Ravi explained it very well, that there is a bit of a myth that higher risk equals to higher return, which has been probably drilled down to us by academia for whatever reason. But I would say if we focus on higher probability and predictable opportunities, it will narrow the range of outcomes, reduce the risk, yet the returns are going to be much, much higher. And I'd say in the last 10, 20 years of my career, I have seen that lower the risk taken in terms of industry selection, in terms of company selection, in terms of promoters and management teams, returns have surprised us on the upside. Good entrepreneurs, good businesses have surprised us through multiple market cycles and despite all the chaos. Another first principle is that we feel this is a symmetrical outcome, not at all. On the contrary, inequality which we see in society, very similar is in the capital market. Few companies champion the industry. Few companies create wealth. Few companies uh, control the profit distribution of an entire ecosystem. So ultimately, wealth creation is asymmetric. And that's the now coming to the product contours. The key building blocks of ValueQuest POISE is that it believes in investing in fast cap, in high capital efficiency businesses, in businesses which have low frictions to growth and quality growth at the reasonable price. Valuations have determined returns significantly, and we cannot undermine that. I will explain these four terms a little more. Usually, we tend to hear the term large cap, mid cap, small cap. But I would say the term that's really important is faster cap. What really matters to us is the speed of growth. If there is a large company growing faster than a small company, we will be going there. What matters is rate of change and change of rate. So the strategy is looking for companies which are inherently and demonstrated growth of 1.5x nominal GDP growth. High capital efficiency, ultimately weighted average cost of capital, अपने अगर बनिया बुद्धि भी देखें तो 12-15% है. So any company which post tax basis does not earn a healthy return on capital is not really something that we would be spending our bandwidth to. Low frictions to growth is high probability, high predictability. ये भी हो सकता है, वो भी हो सकता है, that is possibility. Probability is that you know the direction. The degree could be an outcome of either macro interplay or the promoter execution, etc. Quality is hygiene, and that ought to be, but there is also quality cannot be defined by consensus. So we as a team, we stand alone where it requires to be to identify promoters and companies ahead of the market cycle. So the cliche word quality, pardon me, I don't have a better word, but bottom line is, can we trust the industry, the company, the business financial model, the promoter? And investable valuations is what makes the portfolio strategy. Optimal duration to evaluate is 3 years and beyond. 1 year is too short. 3 years is reasonably healthy to evaluate us as a firm, as a strategy, and also the market cycle. Faster cap, I've already explained. There is no model portfolio. Is depending upon the way funds come in, the way investors come in, everybody's portfolio would be different. It's focused elimination. Half the battle in market is if you can eliminate intelligently, and I will explain this in a lot more detail. And the balance of concentration and diversification. This also I will explain. Now, investment framework, I think it's quite clear from the earlier slides, so I will not delve in. Now, again, there is no straight jackets or fixed mindsets around how do we build the portfolio. We can go across capitalization. We can, for lack of a better word, value growth. We don't agree with those terms, but we can go across those. We are sector agnostic, theme agnostic, old economy or new economy. So the whole purpose is to have all-weather alpha. We do not know when there'll be a bull market, when there'll be a bear market, when the macros will play out, when the micros will play out, etc., etc. When large cap, when small cap, we do not know this. These are usually hindsight discussions. Now, this is one of the most important slides of the presentation where I explain the process. Let's say on the left is the market, which is the entire world. And now, based on some liquidity filters and size and scale, we come to our universe. So that universe is close to 700-800 companies, of a certain size. Now, I'm eliminating companies on capital efficiency. Now, pardon, capital efficiency is not just ROE, ROC. That is a very big distortion because accounting can only have limited imagination. There are several new age businesses which are very capital efficient. There are several other kinds of businesses which probably do not reflect in accounting ROE, ROCs, but are capital efficient. So this is a little more objective plus subjective. So we arrive at the POISE universe, which is usually 20% of the main universe, approximately 200 to 220 companies. This number would be dynamic, obviously, because our markets are growing, and etc. Now, from the POISE universe, we are selecting based on multiple tenets. This is where our research, our team strength comes into play. The focus is to identify companies with demand opportunity, predictability, foreseeability. Can we understand the company 5 years out? Terminal value. Does the company have a long shelf life of growth? And is the company or business institutionalized? So there are various subjective, qualitative, and there's a lot of research that goes around. And this team is all about that. ValueQuest team is about understanding both macros, micros, tangibles, intangibles, everything. And we arrive at the POISE portfolio, which would be anywhere between 15, 20, or a little over 20 companies. Now, like I said, it's very important to intelligently eliminate. So on the left pie chart, the market is the pie and the POISE universe is some fraction of it. Some evidence since the last few years have shown that the universe itself has outperformed the benchmark. Now, what I mean by that is, if let's say the total market is of 1,000 companies, POISE is of 200 companies, and on the right bar chart, I'm showing that 70% of the universe is outperforming. So, which means close to 140, 150 companies out of 200 companies are at any point of time outperforming the benchmark. Now, that means the fund manager is having lesser room of errors of commission, which means that आपका stock selection जो होगा वो automatically would be of a cadre that you will not make major errors. And as long as you are able to eliminate errors, history is evidence that you will end up with well above average returns. Whether it'll be top decile or not will be determined by stock picking ultimately, but that's the broad essence. So the three areas where I am trying to make it more process driven. One, error of commission, which is wrong purchase. How do I eliminate it? How do I minimize it rather? Can't eliminate it. One is through universe selection. Second is our internal research itself is extremely strong. I would say we have a leading edge as a team in research on the entire buy side. Third is access. We have access to all the institutional research. We have access to all the interactions externally to managements and also second level on the ground. So that way we are able to eliminate our errors minimize our errors. Third is false exclusion. कि मैंने जो नहीं लिया वो अच्छा perform किया. Now, some bit is unavoidable. That's okay. You can't attend all parties in life or you can't get everything right. But the other part is, again, because we have the strength of more than 15 analysts and 3 fund managers, it helps cover our blind sides. So I am constantly aware of new trends, new opportunities on the anvil, which can eliminate my error of omission as much as possible. And the third is error of sizing. So I look at it in terms of 4 buckets, 3, 5, 7, and 10%. 10% is where I have absolute conviction, and 3% is where I see, okay, I do not have all the data, but the company has a reasonable probability to deliver over the next 3 years. Right. Now, in terms of expectation setting, see, we all our destination or could be same, but how we reach the destination matters. So the magic number of, let's say, today ValueQuest is completed 13 years, it's delivered close to 19% CAGR. So can we deliver the same over 10 years? That's the endeavor. Now, how do we reach it? The whole objective would be to reach it with as much predictability, with as much certainty, which lower volatility. That's the whole objective. So what POISE is solving for is multi-cap, multi-cycle, and try to be all-weather as far as possible, which requires me to be objective and subjective. One can deploy any amount of capital because it is not trying to maximize returns in terms of, okay, abhi small cap chalega to be in small caps, or yeah, small caps are overvalued to go for large caps. That's not the orientation. The orientation is to have a balanced portfolio which can deliver over long term. Finally, in terms of performance, 2 years have been completed. Over the last 1 year, this has been the result. Over the last 2 years, this has been the result. Up here, I must add a disclaimer that the endeavor would be to build processes, build systems, build feedback loops, which are able to perform over market cycles in terms of research, but ultimately outcome is in nobody's hand. In terms of distribution, of capital as of now. This is where it stands. Up here, there is a bit of a distortion, which I would like to flag. If you see, 60% of the fund is showing as small cap. But that, I think, is I would say, a regulatory distortion. If you see on the right, the weighted average market cap is 76,000 crores, and the median market cap is 19,000 crores. So we are not small cap or large cap or mid cap investors. We are multi cap, and that reflects in the numbers. And these are sizable companies today. A 20,000 crore median market cap is reasonably sizable. Tomorrow or over the course of time, God forbid, if there is an event which is more impactful towards small cap, we would be less affected. That's the whole message. Now, this is where, in terms of sectoral distribution, reasonably well balanced. In terms of performance since 2 years, the SC 500 has given 1.3 crores on a base, and POISE is at 1.7 crores. I think this that's the broad message of ValueQuest. But I think I must end that with what I keep saying, that we are in the right country, in the right time, in the right age, because we've seen enough of markets. All three of us as fund managers have spent now close to more than 2 decades, so closer to 25 years in the market, which helps. Multiple bull and bear market cycles help. The fourth component is equity allocation, and fifth is finding the right partners and the team for your wealth creation journey. That's from me. Over to Abhinav, if I can address anything.
Sure. Thanks, Varun. That was very insightful. I would request the attendees to either put in their questions on the chat or to raise their hands. In the meantime, Varun, let me kick off with the first 1 or 2 questions. So the couple of phrases, Varun, which stood out during your presentation were predictability and certainty. And these are like really powerful phrases, especially in the context of markets. So could you give examples of a couple of sectors or subsectors which actually give an opportunity for you to deliver the predictability and certainty that you talked about, along with risk minimization? And what will also be quite helpful is if you can say which are the top 4 or 5 sectors that could account for a very large majority of the portfolio.
Right. So first, on predictability and probability. See, ultimately, if you see, there are 5 key industries, key profit pools, which have created value not only in India but across the world: financial services, technology, consumer, healthcare, and manufacturing. Now, obviously, these are the 5 super sectors, I would say, but there are nuances to each of these. Within financial services, the retail consumer have created bigger value over long term than wholesale finance. Within IT services and some of the platform companies have done far better than some of the other BPO areas or some of the D2C or classifieds. So, if you come to manufacturing, let's say light engineering, consumables have created higher return on capital, value creation. But now we are also seeing, after more than a decade, the rise of heavy engineering manufacturing, driven by what's happening in the country, in railways, in renewables, in so many different areas. So while these 5 sectors become the holy grail for stock pickers, for asset managers to hunt, and the ones that are avoided are commodities, oil and gas, utilities, or such. But then within these 5 super sectors, there are multitudes of industries, and as capital allocators, we'll have to shift between that to recognize the market cycle.
Sure. Thanks, Varun. Now, there are actually quite a few questions, Varun, on the difference between growth and platinum strategies versus poise. At least 4 or 5 questions. So, if you could address that. But just before that, one of the investors has also wished us well. So, one of the investors says, "May your quest for value and growth continue." So, I would like to thank that particular investor on behalf of ValueQuest. But yeah, Varun, back to you. So how is Poise different from growth and platinum?
Yes, yes. So I think this is a very important question. So first, I cannot overemphasize that as a team, our building block of research, ethos, our principles remain quite joined at the hip. We are ultimately one dream, one team is a term that you have coined, Abhinav. So we live by that even on the investment committee or the investment thesis side. Now, the areas where I'm saying where, let's say, lower risk, high return. Now, platinum and growth are also doing it. It's just that the expression that I might use in terms of words would be different, but they would express it differently. So it's not that, so we three are that way, I would say, have a lot of commonality in terms of thinking about industries and companies. Now, what they are great at, and what are my strengths? For example, platinum is great at some of the industries which are uh, now today really rising in terms of capex cycle or capital goods cycle or the whole capex program that is happening. Platinum, Ravi is really great at identifying that. Growth is when there is very good certainty, predictability of companies over 4 and 5 years. Also, it has very good grip over areas of pharma, of chemicals. So we each of us have some commonality and our individual strengths. Uh, the cycle which happened 2013-14 to now in chemical industry, platinum and growth really played it very well. So if poise would have been there that time, I would have not got it right as much. My core strengths are consumer technology and everything to do with light engineering or consumer facing. The consumer facing could be even within financial services. I am by design because in my previous role for the 10 years that I was, these were the areas of focus for me. Having said that, like I said, we have our strengths, but we also cover each other's blind sides. Our investment team is the same, our research meetings are the same. Uh, we probably would allocate within the sectors weights differently, and there would be a few exclusive companies. So 40-50% of the portfolio would be different, and 50% of the portfolio could be common because of the research team being the same. It's honestly, it's hard to find good and great companies which have the building blocks to scale. So once, if we find that, we all three will jump in. Uh, in some industries, somebody has a better grip, would allocate higher there, and likewise.
Thanks, Varun. Okay, there is a question which probably maybe Ravi should answer. Again, this investor has wished ValueQuest well for us to reach 11,500 crore and for the launch of Poise. So I would like to thank him on behalf of ValueQuest. But Ravi, the question is, ValueQuest has demonstrated good growth already whilst increasing AUM base with your existing portfolios and investment philosophy. So I'm wondering, why would you launch a new portfolio and possibly dilute your focus on the existing PMS and maybe potentially confuse the clients?
No, so the idea is not to confuse the investors or dilute our focus. We very much stay focused on our strategies. So I manage platinum, Samir manages growth, and Varun has been running this strategy for 2 years now. In fact, it's not today that he's going to start managing. The public launch might be happening today, but the strategy has already been running for 2 years already. So for in the last 2 years have been where the
Sorry, we lost you, Ravi. Can others hear?
No, we can't hear Ravi.
Yeah, we have lost Ravi.
Maybe we wait for a few seconds to let him connect again. We'll just wait a bit.
Hi, sorry, can you hear me?
Yes, yes.
Sorry, I got dropped off over there a little bit. I don't know till where you heard me, but essentially, idea is not to maximize return in poise, but it is to minimize returns. So that, as Varun explained during his presentation, there are two parts to it. One is the returns, other is the duration, and third is uh, the allocation to it.
Yeah.
And to achieve that with the least amount of friction in the business as well as on the regulatory front is the idea. So there are certain businesses which, for example, today, a lot of returns in the last 1 year have been generated by buying PSU banks or those kind of businesses that do not stand the test of time through cycles. So idea in poise is to avoid those businesses completely. I know right now we are speaking at a time when the performance is at the highest, but that is precisely why we are launching the product now, because if you are feeling you can generate any kind of return by taking undue risk, but the idea over here is to minimize risk. We are now at a stage where the business cycle has been is already into year 3, and we everyone is sitting on a little bit of gains. So if you want to conserve your returns, protect your downside, and yet grow from here, that's where poise comes in.
There's a little bit that I can add here. Everybody in the world has, let's say, 100 rupee capital. What happens with all of us is that we are trying to put some part into equity, which is basically asset allocation. Usually, we as investors have not had more than 50-60% into equity, some part actually much lower. The whole focus is, can we do higher equity allocation, be able to grow our capital more predictably, more safely, with more sounder sleep, even if that warrants a little lower return. So rather than putting 10 rupees out of 100 and then try and get a 30% CAGR or some moonshot, can we put 80 to 100 rupees at work, and can that grow at 20%? What will really matter is what is the amount of capital that you have put to work and what is the CAGR of that entire capital. So that's what's the meaning of when I'm trying to say that the whole purpose is not just to maximize return, but to get a reasonably high return over medium to long term.
Thanks, Ravi and Varun. There are a couple of questions on the minimum ticket size and the fees. So maybe let me answer them. The minimum ticket size is 50 lakhs, which is the regulatory minimum for PMSs. And on the fees, we have 5 fee structures, from a totally fixed fee structure to a totally variable, and then there are 3 hybrid structures as well. So, I would request the clients who are interested to know about the fee structures to get in touch with your relationship managers, and we will go through those in detail with you. Moving on to the next question, Varun, there's a question on the exit strategy. So there's an investor who says that he is a long-term investor, minimum 5 years, and he's interested to know the exit strategy in POISE.
So I want to clarify here, exit strategy from the fund or within the fund, exit strategy of the individual companies?
No, the fund's exit strategy. So this is a PMS. So obviously, it's open-ended, but
Right.
the interest is to know what is your exit strategy for the companies.
Sure. So when we are making an investment, that itself takes a lot of background work. And I've emphasized this enough, the kind of work that the team has to do or we individually do. So obviously the investment decision itself has taken a long time for us to action it. Now, exit, you're not buying to exit. You're not buying with a target price. You're not buying with, I'm going to hold it for 2 years and that's it. The exit decision is germinates from the point of a few events that happen. Either, okay, the execution has lagged, or the valuations have gone and priced in the next 3 years or 4 years, or there are some regulatory risk for which the whole growth thesis has changed. So there could be multitude of reasons for exit. We try and control, I would say, our investment decisions to begin with. There are few investment decisions to begin with itself. Exit is an event which is more unplanned because you do not know how will the company's execution pan out, how will the market value that execution relative to that company, what are the opportunities that will pan out in the market at that point of time when the fund flows are happening, etc. So it's not I can give you 4 or 5 reasons for exit, but I already gave you 3. It's not an event that we put it on paper at the inception of the investment. We want to hold it as long as things are going great. There's one question that I want to address on that if there is, which I noticed in the chat box, that if there is 50% commonality of the portfolio, then so again, this is an outcome and not that we are looking to have common portfolios. Over the period of time, this portfolio would be significantly different because for 4 or 5 reasons. One, our research team is growing. There would be more idea generation. Second, the size of the capital that POISE can invest, it can technically invest in, let's say, a little smaller company. Some of the other schemes would become much larger. So they could have a constraint of not being able to invest in some of the small companies that I can. Third, you could have weight differences. So it's not just about the stocks being common, the weightages could be significantly different, which could determine outcomes differently. Fourth, entry and exit. So the portfolios and the behavior would be quite different going forward. And that is already evident in platinum versus growth. You'll not find the performance is the same. You'll find directionally they both are doing great, but the performance is not the same.
Yep, thanks, Varun. That's clear. Now, there's another question. Maybe I can clarify on that. The question is regarding, Varun, whether you're overlooking private equity investments as well. So just to clarify, we have a new private equity head. His name is Pushkar Jory. He joined us from Oman India Joint Investment Fund, and has again a long track record of over 20 years. So yes, so Varun does not manage private equities. Varun is responsible for the ValueQuest POISE strategy.
Yeah.
Yeah, and there's one question, Varun, on, and I know it's been only 2 years, but the investor wants to know what is the standard deviation and the drawdown. The investor says the down capture ratio. I'm not too sure what down capture ratio means.
Yeah.
Probably he's referring to the drawdown in this period.
Right, sure. So so even though Poise within ValueQuest is 2 years, but in terms of my fund management career, I have 5 years even before that, and I was part of Nippon mid cap and small cap team. We were uh, four guys who were managing close to 30,000 crores. So I would have deployed at least more than $1 billion over the last 7-8 years. So in terms of fund management experience, I have some fund management experience, I would say, even before ValueQuest. And in terms of drawdown, I would say, so one POISE started in February 22, and then you had the Ukraine war. So it had that period where the drawdown was very little. I'm reasonably conservative in terms of my approach and investment. So during market drawdowns, the fund will probably do very well. But during a bull market like we're having right now, where small caps are flying, that's when I probably need to worry about in trying to stay catch up with the market. I'm not as much worried about a bad year. The fund should do fine during a bad year. So the volatility of the fund would be quite low. I don't have the stats right now ready with me, and the drawdown is not going to be that high.
Okay, great. Now there are some questions that we've already answered earlier. So maybe let me use this opportunity, maybe for Ravi to reiterate what Varun had mentioned earlier about skin in the game. I think that's an important part of ValueQuest's overall ethos and philosophy. Ravi, do you want to just stress on that point about how we demonstrate skin in the game?
Yeah, sure. So one thing is very clear at ValueQuest, that we should all eat our own cooking, and we will not serve any dish which we haven't eaten ourselves. So all the fund managers are fully invested in the strategy that they manage. So all the listed market exposure of a fund manager is in the strategy that is managed by them, and same holds true for ValueQuest POISE as well. Varun's listed market exposure is only and only through his fund. So that goes without saying that we will always have a very high skin in the game in whatever we are doing, and unless we have that kind of a belief, we will not bring any strategy or approach to the market.
Thanks for reiterating that, Ravi. Now there's a inevitable question which you can expect, which is on the market view. So the question is, whether markets are expensive. How do you look at the markets in the near term, given the run up, but the fact that there is volatility as well. So how do we expect to navigate the markets?
Yeah, I'll take that, Abhinav. See, no doubt about it, market are on the optimistic side, but it is not without a reason. We do have strong earnings growth being exhibited, especially see when the corporate profit to GDP cycle is rising, which is the case right now. There is an expansion of the universe of the number of and the type of companies that do well. So it would be but where the risk lies is the fact that not all of it is going to be sustainable. The risk is not that you will end up buying good company expensive. The bigger risk lies in buying lower quality company at cyclically high valuations. That is where the risk lies. So, but having said that, market is $4.2 trillion. 70% of that, which is about $3 trillion, is large caps. I won't say there is any kind of optimism or bullishness or bubble in that large part of the market. Mid and small cap, you can say we are probably one standard deviation above the long-term average valuations. But at the same time, there are arguments which one can make that for the stage of the cycle that we are in, it is to be expected. See, markets never trade at a long-term average. They are always trading either higher or lower. They get stretched to the lower side and they get stretched to the higher side. So what happened during COVID was we saw the point of maximum pessimism. What's happening is now the pendulum is swinging towards optimism, but I won't say go to the extent of saying that this is the point of maximum optimism. We have enough levers out there in terms of growth, profits, profitability before we reach a point that we have tapped ourselves out. Our exports are not doing that great. Rural consumer is not doing that great. These engines haven't even fired. The re-leveraging cycle is about to begin. So no way are we at a point in time where we should reduce our exposure to equity markets. Can we reallocate within that? Yes, that is absolutely possible. Market keeps rotating from a theme to another theme, sector to another sector, and that is what and we need to take advantage of the volatility. One thing is for sure, for the newsletter that we put out earlier in the year, is that expect volatility. And 4 weeks after into the 4-6 weeks into the year, we are already seeing that volatility is getting high. So that goes without saying. In terms of allocating to the equity, stay allocated. Within that, do a little bit of churn to reduce risk is what I would advise.
There's one thing that is more amusing. So if you see 2016 onwards, that's when demonetization happened. Every 6 months, there has been a 100-year event. What is a Six Sigma event? It's supposed to happen in once in 100 years, but actually every 6 months, there has been 100-year event. Demonetization, GST implementation, ILFS, you had 2 wars, you had COVID, you had banking crisis in the US, you had the debt ceiling. So you had all kinds of macro, micro, anything that you can imagine. And yet, where we stand today is a miracle in terms of wealth creation. So in fact, on the YouTube, our channel during July 2020, Ravi has a video where he has put out an abbreviation of COVID as to how it would translate into a bull market, or how the profit cycle will actually get accelerated, and one should see that. So looking back, market timing has been extremely futile. It has been anybody who has heard the macros or has given away based on these events has actually been sitting on a lot of regret. So even now, to question whether markets are expensive, so that's one. Second is, earlier the markets used to be very narrow. Let's say 2006, there used to be only the Reliance group that is rising, or only a one sector or a 2 sectors that are benefiting. Now, India as a country with so many sectors benefiting, the market rally is quite broad. Now, within that broad high tide or wealth creation, can we identify 15 companies to invest? And that's the only ask. So rather than trying to question the market all the time, which is what investors spend most of the time, because of media or a lot of noise in the market, we need to identify managers which can identify 15 opportunities out of this entire huge market. And maybe even Samir, if you want to come in and add your view, we haven't heard you on the market structure, or how are you seeing the opportunities to filter out some good investment opportunities?
No, only problem, there are so many businesses doing well. It's just the valuation. So you have to wait for your strike, and it is not that it has stopped out and world will. In fact, the world has more problems, and global markets are also doing well. So markets do crazy things. We have to see, but we are not at a point where we are going to see a crash. That has been our view. So you find pockets of opportunities and wait for your strike. You've seen it even in this quarter. We do get, and we are concentrated enough, so we don't need like 50, 100 ideas. We have our thing, and there are pockets. I mean, whether it is financials or banking, or whether it is large caps or wherever. I mean, there are pockets which you can't even say which they are expensive. So I think in India that is what has always worked. All these noise has to be filtered, and there will be a point where it will become very risky, and it's our job to kind of navigate it. But trying to be too cute about it has always backfired.
That's right. Yes, Abhinav.
Yeah. So we'll just take last two questions, and I'll actually read out those questions together. The first one is, will POISE look at cyclical or commoditized businesses? The answer is simple, I guess, but Varun, I would still like you to answer that. So that's the first question. And the second question, I know it has been answered, but it's really important to assure the investors, so I will still read it out. So the second question is, some of the PMSs in recent years have performed significantly subpar due to valuations being high and suffering a PE contraction recently. What is POISE's strategy to avoid such a case?
Right. So the second part is easier to answer. See, quality is hygiene. One cannot claim and brag that we are investing in quality companies. Okay, that is hygiene. But getting the combination of growth, quality, valuation, it's the interplay of these three things which ultimately leads to your alpha or return. So the investor who's asking that question, the participant who's asking the question, it assumes that there was disproportionate credence given to only quality, for lack of a better word, and valuations were ignored. And that's why the outcome has been subpar. Coming to first question around commodities. So first, like I'd explained in the 5 super sector dialogue that we had, it's important that these narratives of this will not work, that will not work, also has some nuances that are, so let's say cement. Now, cement is a commodity, but if you see 2003 to 2000, maybe 8 or 10, it could be a 5-7 year, it had a very big upcycle with very good margins, with low leverage, with high return on capital. So whether that be commodity or not. Second, let's say paint is a commodity in US, but it's actually a consumer brand in India. Let's say plastic pipes. Let's say electrical wires. They are brands, and brands which are very capital efficient in India. So one has to find, rather than these tags around commodities or any other sectoral tags, PSUs, the bottom line is to find growth, capital efficiency, and within quality, you are subsuming the area of management, trust, longevity, etc. So that's the only nuance I would like to add. So please be careful around these name tags. There could be periods in which these segments of the markets could do very, very well. And we have seen, let's say, Hindustan Lever, a multinational company, great. For 12 years, it had no returns till 2010. So as a team, we would guard ourselves with any kind of mid cap, large cap, small cap, value, growth, commodity, specialty, bulk. Within technology, there are so many nuances. We have to be safeguarded towards any kind of permanent brackets.
No, absolutely right, Varun. You're right about not doing name tagging and painting something, with a broad brush. Uh, Okay, I think with this, we have come to the end of the call. I would like to thank every participant for being with us on this call. And I would like to wish everyone, all the very best for their weekend. Ravi, do you have any closing remarks from your side?
No, I'll just reiterate. The idea is not to time the market. The idea is not to confuse the investors. The idea is not to provide one more similar offering. The idea is to essentially protect the gains. Idea is to minimize the risk and sleep peacefully at night. Tranquility with poise.
Thank you for the opportunity, ValueQuest team. Can't be more proud to be associated. Ultimately, in the long run, it's the team that goes far. That's my closing remark.
Perfect. With those thoughts, thank you everyone once again.
Thank you. Thank you so much, Abhinav.
Everyone.
Thank you.